Okay, let's get the show on the road. Again, thank you all of you for joining us today for this 5th episode of the Discerning Distributor Show, where we're going to be talking about attracting and retaining top talent in this hyper-competitive, candidate-driven market. I know that there's been a tremendous amount of change. Many of you are struggling and continue to struggle despite a potentially slowing economy to find, hire, and then, of course, keep the people that you have. So I am absolutely delighted to be joined today by the dynamic duo from Labor IQ by ThinkWhy, Denton and Dr. Mallory Vachon. I wanted to ask them all sorts of questions. They track the labor market to a level of detail that even I'm incapable of doing, and always have terrific insights. I know they're going to provide a huge amount of value for our audience over the course of the next hour or so. So let's just get right into it. First, I would like to introduce our guests for this episode. So let's start with Jay. Jay serves as the Chief Labor Market Analyst for ThinkWhy. He's charged with leading the product and market analysis business units for Labor IQ. His expertise in analyzing and distilling complex data into actionable insights supplies the industry with the why. And I think that that's such an important part. Why does it matter? And he provides all the answers for strategic business and talent decisions. I'm also joined by Mallory Vachon, PhD. Mallory is the senior economist at Labor IQ by ThinkWhy, and she has the responsibility of leading the research team that produces key insights and forecasts related to the labor market. She's focused on providing clients and the general public with sophisticated yet accessible analyses that inform business decisions and an understanding of labor market and employment dynamics. Jay, Mallory, thank you so much for being here today. It's a true privilege and an honor.
Thanks, Alex.
Of course, Alex. Thanks for having us.
Fantastic. Well, as always, I want to encourage the audience to send in your questions. You have a tremendous brain trust of talent here. Pick our brains, ask anything that you want about labor, about hiring, attracting, retaining people, and hopefully we'll give you some practical and actionable advice that you can take back to your own organizations. But Jay and Mallory, let's start the conversation by kind of looking backwards a little bit. If you were to recap the past 2 years, obviously we've seen a tremendous amount of change since the pandemic began in early 2020. Talk to me a little bit about how we got to where we are today. Jay, can we start with you?
Sure. I'll give the quickest recap of the last 2 years, which has been unlike anything anyone has ever experienced, I think, in their personal or professional lives. You know, obviously before, I think this is the thing that people forget about. Before the pandemic, we were in one of the tightest labor markets in, 50 plus years. And so it wasn't like finding talent was that much easier before the pandemic. It just got a lot harder after it. So, roll back to that early part of 2020, we lost more than 20 million jobs in what was almost overnight. And then you had record-setting recovery of jobs, something that we had never seen before. And so all this hiring started to occur. People started to adopt technology that had actually been around for a long time, but people started to adopt that. We then had to deal with things like remote work. Once that happened, all of a sudden, we're here in Dallas. The competition for labor changed, at least for certain types of roles. Those that could be hybrid or could be remote. Now, even here in Dallas, we were facing more competition of hiring from, say, California or New York. And so that is part of what set off what's been called the Great Resignation or the Great Reshuffle. Now, it can be different depending on your industry. We also had a lot of people just stay in the same metro and they just switched industries for one reason or another. We've had a lot of things happening on other parts of the planet. War in Ukraine, obviously, as one, responding to how fuel prices and so on are changing overseas and how that impacts some of our prices here. Add all that up, inflation starts to, as we say, inflation went bananas. It's not exactly an economic term that Mallory probably went over when she got her PhD, but it did. And so we've been battling all sorts of things. And the market has been hot for a long time, maybe too hot for too long. And so now we're sitting here with, I would say, Mallory and I, gosh, we do so many presentations, a lot of writing. And I would say, I gave a presentation yesterday. We had to submit the summary back in May. And from May, a presentation you're given in October, and we're sitting there shaking our heads like things are going to change so much. And I know we'll get into that, but that's a little bit of how I think we've gotten to where we are. And so we're sitting here with, again, really low unemployment rates. It hasn't gotten any easier to find talent despite headlines of layoffs, and we've still got a bit of a challenging time ahead. And I think we'll get into our outlook for 2023, but it's going to be a very interesting situation from an economic perspective as we approach next year.
Yeah, I think that's an understatement to say it's an interesting situation. Mallory, did you want to add anything?
Yeah, so I think kind of bringing it up to where we are now and thinking about what, as Jay mentioned, before the pandemic, we were in the tightest labor market for 50 years, and we're kind of right back to where we started. The unemployment rate is at about a 50-year low. It just ticked down in the latest reading back in early October, like a couple of weeks ago. And one of the things that makes it even more challenging to find talent is that the labor force, while recovered, from pre-pandemic levels, is still maybe 1 to maybe 4 million below where projections would have put it in the absence of the pandemic. So while the pandemic recovery has been really strong, it's also created a lot of chaos and, moved people out of the labor force, either through early retirements, through sicknesses, through, there was just a economic study released saying that there have been more babies born than expected. And so that might pull some parents out of the labor market. So there's just not enough talent to go around. One potential upside of that right now is, as we hear about layoffs, while they're in the news, there isn't a whole lot of evidence that has actually started to tick up overall, right? That the unemployment rate is still at historic lows. Even this morning, we saw, first-time unemployment claims were down week over week and are still, again, near historic pre-pandemic lows. So maybe some of that labor market tightness I think one of the benefits could prevent some larger scale layoffs like we saw during the Great Recession.
Yeah, I keep hearing about this concept of job hoarding as we look out towards the future.
I just read an article about that this morning.
Yeah, the idea is basically companies are willing to take lower profitability to maintain the people that they have, even though the economic environment around them might be slowing. So we'll see if that actually holds up, depending on how far the Fed pushes rates, how much demand destruction they're willing to endure. And certainly one of the goals, I believe, of the Federal Reserve is to cool the labor market. So we're starting to see some of that happen. I mean, one of the latest figures that I saw was that we lost about just over 1 million job openings in the month of September relative to August, right? And that might lead companies of all types, but certainly distributors as well, to think things are starting to improve. The pendulum is starting to swing the other way. What I also noticed and haven't heard much about is that the number of people searching for work also declined by almost 1 million people, right? From something like 6.2 million to 5.5. Can you talk a little bit about, what we're seeing more recently and how that compares to kind of the last 2 years in terms of some of the data points and what the takeaways from that should be?
So I'll take that and then kind of pass it over to Jay. So I think the 1 million decline in job openings certainly is a sign that things are probably starting to cool a little bit. There's maybe a little bit less demand out there. That is still well above our pre-pandemic norms. So even looking through kind of, right before the pandemic, we were in the 6-7 million range, which was much higher than, we had seen in the decade previous. So we're still pretty elevated in terms of that labor demand piece. I think, I would imagine that will start to tick down a little bit more, and that will sort of cascade through, job openings, fewer job openings. Well, there's probably going to lead to fewer hires because there are fewer people, there are fewer openings, fewer people getting new jobs, and then therefore fewer people quitting their jobs. So lowering that turnover, which should kind of bring down some of the wage growth we've seen and then, coupled with the Fed's rate hikes to stem inflation.
Right.
Yeah, and we expected this. Yeah, Mallory and I produced an article, I would say it was probably back in May or June, where we laid out what we thought would happen in terms of, okay, the economy is going to start to soften a little bit, and here's the way that we think it'll play out. And it's what Mallory, just covered, that businesses would start to open fewer jobs, and then it would have that trickle down effect. Well, the one thing I think from an employer standpoint, so I know we've talked a lot about, trying to hire, but if we then focus on the retention side, so the fewer job openings also usually means fewer recruiters coming after your people, or fewer other opportunities for those that might be willing to go look for a job. There aren't quite as many other opportunities out there open. So, when we think about next year, there obviously is likely to be some sort of softness relative to where we've been. I mean, we've been on an unsustainable pace. So no matter what, we're likely going to moderate down. It's just how much. And I think the good news for businesses as we start to get in that environment is all of the turnover that companies have been experiencing beyond anything that they've ever seen before. That should start to get back closer to normal levels. So on the hiring front, you're not going to have quite as much competition if you're one of the businesses still out there proactively able to hire in whatever next year's environment looks like. Also, on the retention side, your people aren't going to be getting, depending on the types of roles, all the calls that they've been trying to fend off, or if they're on LinkedIn, all of the, messages that they've been getting on there.
So if you are a distributor and you're hearing this message that things are going to start normalizing and getting back to kind of the trend in the labor market that we saw before the pandemic, what does that mean to you? What should you be thinking about, and how should you be behaving in light of these developments?
Yeah, I mean, I'll start off. We're not a distributing company. We're a software company. We have software that recommends salaries for roles all across the country. The labor market is what helps fuel those recommendations. That's what Mallory and I do. When we start thinking about our product, though, I would say that we went through a session a couple of weeks ago where we were thinking about next year and things that we wanted to target next year, focus on next year, and that's what companies are. If they're not doing it now because they're already in budget planning season and so on, don't do it in the vacuum of the way that things have been. Start thinking about, and that's what some of the value we hope you bring on today's call. Start thinking about what it might mean if, we've been adding, millions. I think we're probably at a 5 million annual pace of jobs right now. That then would have an impact on how many people are getting jobs, buying new things, and so on. And obviously, you've seen a lot of wage growth come along with that. If I told you that next year, the economic environment maybe on the top side, instead of 5 million jobs, or in a normal time 2 or 3 million, it's only going to be about 1, maybe. It could be negative. That's, in fact, if you look at the Wall Street Journal's latest forecast, where they survey a lot of economists and say, what do you think is going to happen next year? On average, they do think job growth will go negative, not severely, but at some point next year. So let's just imagine demand flattens from where it is. If we told you that as you're going to do your planning for hiring, production, and so on, that's the way that I would be thinking. We're likely looking at a period where consumer demand will be a bit softer. If it's business to business type demand, probably a little bit softer, but like in other types of downturns, it'll probably hit some industries and some types of jobs differently. And so I think know that some sort of slowdown is likely on the way, which will impact the entire thing that the Fed's trying to do is slow down what's been happening. So that's going to hit most places. It's going to be slower. So think about that when you're doing your business planning, whether it's your product or your people.
Very good. Mallory, anything to contribute?
Yeah, no, I think to Jay's point, also taking everything, that we talk about on this podcast and anything that you're hearing, and really being able to serve in an advisory role, either with your internal teams or internal leadership teams, or to your clients externally, really to provide value, because as things do slow down, there will still be hiring, there will still be labor market activity. And I think, how do you differentiate yourself from either your competition or others is really through that advisory, through data, through, that leadership that you can provide, and additional information that you can provide your clients as we kind of navigate through a much tighter time.
Yeah, and I think another key element to remember is, just because we're talking about a slowdown at the macro level, right? If you get into different industries, they might experience that period of time very differently, right? So if you're in oil and gas, and you have, based on your comments earlier, Jay, the war in Ukraine is driving Europe to reassess, let's just put it mildly, where they're getting their energy supplies from, and America stands to benefit from that. So, if you look at oil and gas, we're not likely to see major layoffs or job contraction in that sector, right? But other industries might feel that for sure.
Right.
Again, I want to encourage our audience to submit your questions using the Q&A tool. We'd love to engage with you directly. But while you're thinking of some of those questions, I wanted to ask a couple of tactical things related to what we just talked about. One of the things that we've seen throughout the pandemic is a fairly low labor force participation rate. It hasn't quite bounced back to where we were before the pandemic. So I'm curious if you think that a slowing environment is actually going to draw some people into the labor market. And then a follow-up thought on that is, what is the likely impact to wage growth going to be as a result of both the slower economy and potentially a higher labor force participation rate?
I'll take the top. So I think there's two interesting things. So it's a really small number of people, but right now there's basically a record number and rate of people that have two full-time jobs, right? So which kind of speaks to the strength of the labor market, that there are just, and the labor demand that's out there, that there are people, I mean, there's other, maybe downside effects of that in terms of other things, but that there is just enough jobs out there that there are people that can easily have two full-time jobs. I think the other piece is just thinking about, the labor force participation rate has been going down over time. We kind of are up against like a demographic challenge, right? As the baby boomers age out of the labor force, that number was going to start ticking down. And how to bring people back in, I think inflation likely, as well as some deteriorating economic conditions, could bring people back into the labor market just because they need to earn money and support their families. And, we'll kind of see if that happens going forward.
Yeah, Jay, you mentioned you guys look at salary and compensation data. What are your thoughts on the impact here?
Yeah, well, I think first, we went back and looked at our forecast from before the pandemic.
Yeah.
And when we looked at it, estimating we should have somewhere, and a lot of factors would play into this, but somewhere between 2 and 4 million more people in the US that either had a job or would be looking for a job. So that's the labor force. So 2 to 4 million extra people out there, and they're not there. So we started to break down, well, who are those people? Why are they not here? Who are we missing that we would have had in the labor market that we don't? And obviously there's an entire COVID impact of people who are no longer with us. Outside of that, though, you start looking at, say, international immigration that was basically shut down for a couple years. And so we're missing, more than 1 million people that normally would have moved here during that time and would have been taking jobs primarily, well, I wouldn't say primarily necessarily, but a lot of roles in tech or healthcare or some of those where they just haven't been able to, to staff those roles. So that's one part of it. We then started looking at, and Mallory mentioned this earlier, so more on the demographics of there are more females still out of the labor force right now. And then if you take the greater than 55 population, more of those. And so then you start asking all those questions of why. And there's not one answer. There are a lot of answers. Mallory mentioned one of some females. There could be a baby boom come out of the pandemic type era. That's maybe one part. Or a spouse that's living might have more income because of how much wages have gone up and so on. On the greater than 55, so when we start thinking about participation rates, some of the places I guess my brain goes is, what would have made it where someone over 55 could exit the labor force a little bit earlier than typically they would have? Well, you go back and you look at the early part of the pandemic and 401ks, the stock market, just going through the roof, right? And yeah, and so that's obviously heading the other direction, and that is one factor that could pull more people back. If you had two people in a household and that person that was able to cover the cost for both, if that person's job is impacted in some sort of way, that could push another, both of them potentially back into the labor market. So there are some things that for unfortunate reasons, I would say, could raise the labor force participation rate just because of some of that. The impact on wages, I think the way that we see it when we go to forecast out for next year, you've had in some cases this kind of runaway at the top end of the market, where whether you call it irrational pay or whatever, that's kind of a phrase that we use, where we do all this economic modeling and you can't come to a reason why this company paid this person without a whole lot of experience that much money. And there's been a lot of that over the last couple of years. I think a lot of that's going to simmer down. And so for a lot of different types of roles, not just tech jobs, I mean, we got roles in all sorts of industries like this. I think the top part of that compensation market is going to hit a bit of a ceiling. If you're still one of those companies that haven't caught up, you're still going to be exposed to other companies, other places that might be able to pay your folks more. But we do think that a slowdown will start to slow, at least, especially the top end of that wage bracket. But then also the whole thing we think will start to moderate once we get into 2023.
So a couple of things that you said kind of resonated with me. From an opportunity perspective, would you say that perhaps some of these underrepresented categories, whether it's women 55 and up, potentially if immigration opens back up, do you think that there's an opportunity for companies that have been struggling to attract workers to look at those segments of the population specifically and say, as some of those may be coming back, we really should be looking to attract more women or more, 55 and up categories, or particularly, in the immigration side, you mentioned a couple of like healthcare and IT, but typically immigration into the US feeds manufacturing and construction and agriculture, right? What should those companies be thinking about? How to capitalize on some of these trends, I guess, is what I'm really asking.
Yeah, the message we give is next year's labor market could look significantly different than this one. So whether it's, again, attracting your employees, retaining your employees, I think that companies are going to have to reassess how they do that. Do you still have to go remote or hybrid or not? Or is it going to swing a little bit back more in the employer's favor in terms of having some more control over those things? So I think the number one message is just don't, whether it's compensation, the way you hire, the messaging, how you're presenting yourself out there, reassess how the market changes between now and I would say early to mid part of next year.
Yeah, be data driven in your decision making, as I always try to suggest to people. Mallory, did you have anything to contribute?
No, I think everything that Jay said is on point. I think the one piece is that, we've noticed women, sometimes women of color, have throughout the pandemic have really just not rejoined the labor force at the expected pace. And I think a lot of guidance has been given to companies about increasing flexibility or certain arrangements that may be useful. But I think part of it could also just be the types of work that certain demographic groups end up in, is that, it's not like if you're a nurse or a healthcare provider that you could just have flexible hours, right? There are shifts, there's things that need to get covered. So I feel like there's just an opportunity to really, like Jay said, really think through any ways of really creative ways of being able to bring people in and, either reskilling, upskilling, or figuring something out, or adjusting your expectations for education experience and the types of skills.
Yeah, I know that you track, you're the data whiz at Labor IQ, and one of the things that I believe companies really need to understand is that when you hear top level data, like an unemployment rate of 3.5%, or, nationwide, here's what the picture looks like, there's a lot of variability, both from a geographic perspective and a position perspective, right? Can you talk to us a little bit about what are the key data points that you're tracking and what are you seeing in your analyses?
So it's really interesting so to both of those points, 100%, Alex, agreed. Like looking at across states, right? Texas has one of the hottest labor markets in the country. Our unemployment rate is above the national rate. What does that mean versus Vermont, which has one of the lowest unemployment rates? But I don't think, people would say necessarily the same thing about the vigor of the Vermont economy like they would about Texas. But part of that is there's more opportunities. So there are more people who are able to leave jobs and then get another job. But when you look even within Texas, it's, where we're located, Dallas, Austin have unemployment rates that are at or below the national average. And then, looking to California, the unemployment rate is a bit above, and there might be other reasons driving those. Then digging into certain occupations, I think we were digging even deeper. I think women in legal, there's a 0% unemployment rate, Jay, if that's correct.
It's men. So men in legal is women in life and social sciences is 0% is if you go to BLS right now, it says, it doesn't really say they're all employed, but it's less than 0.1% unemployment. It's incredible.
And then healthcare, management, business, and financial occupations all have unemployment rates below 2%. So fewer than 2 out of every 100 people are, looking for jobs in those fields. And that's, do they have the exact skills, education, experience that you're requiring in your role? You're talking, needle in a haystack type numbers.
Yeah, Alex, I would say, Mallory just mentioned management. I think it's a great concept as we work with clients. And Alex, you use our tool and look at our supply gauge for certain roles and so on. And And part of the advice that that we give, and companies are almost forced into this, by the way, what I'm about to say. So management roles nationally. So anybody listening, watching this, if you're trying to hire a manager, management roles have an unemployment rate of 1.8%. All right. So there are practically hardly any that are out there and unemployed. There are a few, sure. Oftentimes, you don't just want a manager, you want a manager who's been there, done that, they've got all this experience. Theirs is lower than that. Okay. So when we start to speak with folks, if you've really been challenged for some of these roles, look, the reality is you're going to have to find folks that don't necessarily have the experience. If you want to hire a manager, you're likely going to have to look for somebody who's ready to be a manager, not already a manager. Different type of role. I was speaking at a conference yesterday, and I brought up the data science position. So as many of you are familiar, technology roles, also very low unemployment rate. And the gentleman in the crowd said the same thing that I think that we've been seeing, and what I'm talking about here is, look, our only path to success that we've seen, I don't mean just us, but this gentleman in the crowd said, we have to hire people and train them up and get them in this role. That's the only way that we've been able to maintain these hiring volumes. Even if the labor market loosens up over the next year or so, I don't know how loose it's really going to get. And so even some of the unemployment rates, if the unemployment rate goes up to the mid to upper 4% range, that's still relatively low. So the strategies that we're talking about, you're talking about hiring now, early part of next year, 2024, it's really going to be about getting people into those roles, train them up in that job. Getting people with experience is going to remain very, very tough.
Yeah, I think that there are a couple of key elements that I wanted to highlight for our listeners there. So Jay's advice in terms of, hiring people and then training them to be managers, you have to focus on this key term, training, right? As a recruiting organization here at Miller Resource Group, we see this all the time. People primarily leave businesses because of their direct manager. That tends to be one of the biggest drivers. And yet the way that we promote folks internally doesn't have anything to do with managing other people, right? You're a good salesperson, great. You're now the sales manager. You're good on the service floor. You're now the production supervisor, So we have to provide that management training in order to retain the folks that we have, because that's where most often conflicts arise. And it's fascinating to me to see that, people get put into those management roles and told, okay, you're now responsible for talking about DEI, mental health, people's personal lives, and yet they're given no training to do that. So it's a really interesting part of filling those roles. So again, as you look out towards the future, keep in mind, it's going to be about that particular position. It's going to be about the industry and the location where the job is. You can't apply these broad-based metrics to what you're hearing about the labor market overall. You got to look at it unique in terms of that position, those people in that place, right?
Yeah,
absolutely.
Yeah. All right. One of the things that you touched on earlier that I wanted to come back to is this idea of remote work, right? I mean, WFX, work from anywhere. This trend was obviously super hot in the early days of the pandemic. We've seen some companies start to trend backwards. The CEO of JP Morgan, for example, believes that more people need to come back into the office. Talk to me a little bit about what you're seeing in the labor market data in terms of, are companies actually doing this? What does the stratification look like? And kind of what your expectations regarding that are?
Having been in jobs basically my entire career that, I could take a laptop anywhere and do, we might have an inflated sense of the level of work from home. So there's actually only about 13% of US workers that are fully remote. Another 30 or so percent that are hybrid, and then 57% are fully on site. So really, when we think about it, there's about 43% of the workforce that is either fully remote or hybrid in some capacity. And, I think that's really, what is going on in the labor market. And a lot of times, for most jobs, if you're in a service sector or retail, right, those jobs can't be done remotely, or most manufacturing type roles as well. There's just not a capacity to do those jobs remotely.
Yeah,
Yeah,
Absolutely.
Alex, I'd say it's been refreshing. I've now had 2 interviews in a row where the candidates were not just open, but really wanting to come into the office, and I love that. It has not been the case the last couple of years, and sometimes it's people's personality and their wiring and so on, which one they really prefer. But I'd say I could even take the opposite angle. So Mallory had mentioned 40-something% have some degree of work remote. Well, if you take the other and you say, well, how many work in the office at least part of the time or all of the time, or at the location part of the time or all the time, that's like 80, almost 90%. And so the reason I start looking at that is because I think about I was in real estate for a long period of time, and I think about migration patterns, and the locations where the people who are dialed into this are people still moving to that town? Are you still able to attract those? And so it depends on the type of work, obviously, which of those are actually going to be on site or not. But I would say the places that tend to attract a lot of people still do. So your Dallases and your Florida and Atlanta and Phoenix and the Carolinas, they're still attracting a lot of those folks in. And so even if they're sometimes now being hired, they moved to Texas and now they're working for somebody in California. I also think about the migration patterns, because it's about where is the talent supply that you're trying to go get. And I think the things that we've seen before the pandemic are still playing out now. That the places that attract talent are continuing to. So whether they work remote or in that town, we're still seeing similar population movements.
Even after the hurricane in Florida, people are still thinking about moving down there, huh?
It just, hey, it happens over and over. I was in Carolina for a couple years, and I also know that every hurricane hits North Carolina one way or another. So yeah.
Fantastic. Susan Holiday, I do see that you raised your hand. If you don't mind, please put your question into the Q&A box. And I want to, again, encourage all of the rest of you listening to do the same. You have this amazing opportunity to pick the brains of some very, very smart people about what all of this means to your organization. So please do send in your questions. While you're thinking about that, I wanted to shift gears a little bit and kind of look at the future in a little bit more detail. So we've already talked about what could happen, but I know that at ThinkWhy you guys do a lot of modeling and a lot of scenario planning. Talk to us a little bit about what are the potentials that are likely to come down in 2023 and beyond, and then maybe what you think is the realistic likelihood that some of that will happen.
So I'll go through kind of our outlook, our scenarios, and then I'll let Jay kind of take it on, we just had some very crazy international news this morning that may be affecting us, sooner or later as well. So I feel like this is a situation where everything is very much in flux, and a lot of the dynamics that could impact us here are still changing by the day, and that we don't even have a lot of control over. So I think our optimistic scenario is next year about 1 million or 1.5 million jobs added. So in a normal, really strong year pre-pandemic, 2 million jobs would have been great. So still about half of what would have been a really good pre-pandemic year. The pessimistic scenario is a net loss of jobs, in the realm of 500 to 700,000 jobs lost. So things dip for a little bit, but start to recover. So the optimistic scenario, we have that soft landing that we keep talking about, or you might have heard about with the Fed, moving things just right so that we don't kind of completely descend into chaos, but we just manage to thread that needle perfectly. Or, the, other side of that is a recession, much more broad-based layoffs. So if there's a soft landing, we would expect these interest rate hikes only have a mild impact on industry growth. Maybe the negative impact is isolated to financial, mortgage, and a few other related sectors, but doesn't spread too much throughout the rest of the economy. And then thinking about, another optimistic outcome. So the backlog of the open jobs, we talked about this earlier. There's so much of a backlog of open jobs. There's still a lot of demand out there in the economy. The labor market is still really tight, which may, and to your point, Alex, earlier about talent hoarding, companies may be less willing to lay people off, knowing that it's going to be really hard to find new people when we come out on the other side. And then I think, the pessimistic scenario is we lose a lot of jobs, but hopefully by the end of 2023 or early 2024, we start kind of getting back above, zero and kind of really start adding jobs again and moving forward.
So what's the baseline, Jay? What do you think is the likeliest outcome here?
I think we might be somewhere in the middle. The number one thing is typically if we do hit, I know technically we could be in a recession now, but we're not seeing it in terms of like labor market impact, obviously at this point. Any labor market number you look at looks solid. If you didn't know anything going on with inflation or you're like, wow, this is incredible. But all these headwinds just keep getting stronger. And so I think it's going to be hard to, I'll play it out like this. People have asked me, like, just keep it simple, like help me understand the Fed raising rates. How's that going to result in job loss? I don't understand that. And so the place where I like to start, again, I mentioned, real estate. If you think about housing and the price of a house. So the price of a house jumped nationally. If you took the average home price, jumped from $375,000 before the pandemic, so summer of 2019, so 375,000-ish, all the way up to 525,000 within a 3-year period this past summer. So inflation in terms of home prices, right? And so they're trying to get that type of thing under control. So interest rates, when interest rates go up, one of the easy things you can look at to see that where people get impacted would be mortgage rates. So you're what it cost you to take out that loan. Mallory and I did some quick math using some online mortgage calculators, and what you could, so if you bought one of those $525,000 houses, let's say last year when interest rates were 3% or below, $525,000 with today's interest rate for the borrower to have the same monthly price, because they have a budget, their budget can't readjust with the interest rates. That house that was $525,000 with an interest rate just below 7%, it's only $375,000 that you could sell it for to keep it at the same price, right? So you can see that the price of a house in terms of the actual, dollar amount, not the monthly, is coming down. So that's one, just to show like, hey, here's how a price gets under control. But then what are the impacts of that? If we just stick with the housing market and see maybe how that might play out. So we're already seeing home sales drop. I think the number just came out this morning, depending on when people watch or listen to this. This morning it came out that home sales volumes had dropped for the 8th consecutive month. They're likely going to continue to drop. Home prices are going to continue to come down. When that happens, people can't sell their house. So the mortgage industry is already being impacted. It will be impacted more. So that's like one way you can see how jobs are now being impacted. When those incomes go away, those people now can't buy as many things, right? So that's one extra step that you could look at. But then you think of all the other things with housing that are now going to be impacted. So distributors, if you're distributing things that help build houses, there aren't going to be as many houses built. For the retail stores that store those things, you're not going to have as much activity there because people aren't going to be renovating houses. So you're going to have fewer specialty trade contractors doing those types, so you can see how just housing now starts to impact those types. The question's going to be, so we can actually go back and look to some degree. We're not saying this is going to be like the Great Recession. I don't think anybody's saying that. In fact, right now, if you take the Wall Street Journal's latest economic survey, which has, I think it was 66 economists that responded to at least portions of the survey, they think the length of recession will be about 8 months, which is lower than normally that it would be. So most people think it's going to be a quick drop, not too deep of a drop, and then we'd be back on the other side as the Fed. Then they'll be watching to see, hey, when can we see some softness? Actually, when is this under control? And then I think they will be diligent in terms of starting to bring that rate back down at a pace that makes sense. And so I know that was a kind of a long explanation, but I feel like housing is something that people can understand and the impacts of that. But then once it starts to happen, the hope is that it will be short, mild, and we'll be back on the other side, which will then be back into a labor market that's really tight, and we'll keep trying to figure out how to hire people like everyone else.
Right, exactly. I think this is a key point to continue to stress, which is, we tend to react very emotionally and kind of with raw fear when we hear the term recession, right? And that's because the last 2 recessions that we've gone through have been so surprising and so painful. You look at both the pandemic-driven downturn in 2020, which lasted all of a quarter, and then we shot right back up, but also the Great Recession of 08, 09. And that's where our minds immediately go to when we hear there's going to be a recession. And depending on which definition of recession you follow, most people think that we're already in one, right? If you look at GDP, 2 consecutive quarters of contraction, we've had that. I talk to a lot of businesses that say our order books are still full. Our backlog is long. We're not really seeing a destruction in demand for our goods and services. So again, have to look at it segment by segment. But perhaps what we're really starting to understand is that a mild and brief recession is actually good for the health of the US economy, right? We've been going full out. Most companies can't keep up. They can't hire the workers that they need. And perhaps this gives us a chance to collect our breath a little bit, catch up, and kind of position ourselves for the next rising trend. I guess with that in mind, when you look at a little bit longer term, right? And this is, I know we didn't talk about this, but it just lends itself very naturally to the conversation. Do we have the right things in place, the right recipe, if you will, for long-term economic stability and job market health in the United States, given all of the factors that we've been talking about? Just your thoughts on that.
Go ahead, Mallory.
Oh, as we say, I think, the labor force is really the biggest challenge. And I'm sure Jay was going to say the same thing, since he and I have been talking about this, nonstop for the last couple of weeks as we prepare for various presentations. But I think that's really the biggest challenge. And it comes back to we're below where we probably should have been for a whole host of reasons. You can't just materialize people out of thin air. I think, one of the best things we could do, at least to increase the labor force, is to get immigration back to where it was before the pandemic, or, before the last few years. And then just, like we said, any creative or ways to just bring people back into the labor force, and figuring out, what types of incentives people need, because really that's going to be one of the biggest limiting factors to growth once we come out on the other side, I think.
Yeah, I completely agree. Was going to the same place Mallory was. Alex, I think you used the term recipe. If you're thinking about making a dish in a recipe and you open the cupboards and they're bare, there's nothing in there. That's kind of what the labor force is like right now. That you just don't have the people there to actually fill nearly all these jobs. And when we get on the other side, even long term, we need more people in the labor market. We need more people here. Immigration's one of those routes. We'll have to figure out how to get people, potentially more people that are considered prime working age. That definition might change over time, but within that, higher participation, although it's already fairly high, it's the 55 plus. Given the number of baby boomers we have, having them stay engaged in the labor market for a longer period of time, I think will help. But eventually, it's going to be hard to sustain, really strong job growth, because we simply don't have enough people.
Yeah, and it's not an easy thing to overcome, right? I mean, immigration policy has been kind of stuck in a quagmire for many, many years. We have this obviously bifurcated population that have very different views about how we should handle that. And, this is not a political statement by any means, but there's really not a whole lot of immediate hope that they're going to figure it out overnight, right? But we do have a birth rate that is in decline. We're not creating, and I hope from your earlier comment, Jay, that we do have a baby boom as a result of the pandemic. So far, we haven't seen much about it. And, younger generations are less likely to want to have kids because the cost of doing so is so prohibitive, right? So this topic of, the limiting factor, not just for the overall economy, but for those that are in the audience and on this episode that are listening, is going to be people long term. And this notion that people are your most valuable asset, and how do you handle that as you look out to the future, I think is something that everybody has to take a long, hard look in the mirror and answer for yourself, because it's not going to fix itself overnight, right? So it's a challenge that we're going to have to continue to struggle with, it sounds like.
Yeah, and I agree. And oftentimes I do have to also preface, when we talk about immigration, it's not a political thing; it's numbers. If you look at who knows if any baby boom, probably not, would materialize, but that is a concept, that's been discussed. even if it was, they're 18, 20, 25 years away from contributing
Right.
to the job market. And so if you look at, it's really easy, go and look at live births by year in the US. So you're rolling back now to for people that would be entering in the labor market now, sometime around 2004 and maybe a little bit before, and births in the US were down. And that's a trend that we're going to be facing for quite some time as we move forward. And the only way to keep that number level with, if you roll back 10, 15, 20 years ago, when millennials started coming through the labor force, and you had that, big growth, and you had a lot of different industries that benefited off of that. Like I was in the apartment industry for a long time, and you had all of these young folks who were going to live in apartments. Well, now they're in their 30s and 40s and so on. That industry is still doing fine. But the point being that if you're in a space where your typical worker is in that, late teens to early 20s age, we're having fewer and fewer of those every single year as it moves along. And so there are only so many ways to get more workers out of that group.
Yeah, definitely. Mallory, anything you want to add?
No, I think Jay covered that pretty well.
All right. Sounds good. So the last segment, and we've touched on this both from our discussion around inflation and in terms of wages. One of the things that I observe when I talk to some of our clients that are trying to hire is the struggle to keep up with what the wages equation has been doing. I think if I remember correctly, the labor IQ data shows, somewhere between 7 and 10% average wage increase over the last year or so. Obviously, with what we've been talking about with the economy, that's going to change. So I have two questions for you. Number one, what are your expectations for wage growth next year and possibly beyond that if you have a longer term vision? And then number two, what can companies be doing in terms of engaging both new candidates that they're interviewing and their existing workforce to try and address some of the discrepancies that we've lived through for the last 12 to 24 months?
I'll take the first part and then kind of pass it along to Jay. But I think what we've seen over the last years, like you said, is when you're comparing the salary that is needed to bring someone in the current market, it's been 7 to 10% above what current employees in that position are making. So you then you think about going further on, okay, so now you have current employees, you have a new employee who's now making, maybe 10 grand more than your current employees. And you create these internal equity challenges and then cascade that through the next year. If someone else takes another job increase, you can really end up with a lot of spread between what the person who has just switched jobs is making compared to what their peers who have been in the same role for 2, 3, 4, 5 years are making. And so I think there's two things, right? That creates a lot of that internal equity. So companies really need to understand, hey, is what we're paying our current employees enough? Is it competitive in the market? Can they go out and get a lot more? And really try and figure out ways, even if they don't have the budget, to be creative to make that right. Because turns out filling that position is going to be even harder. Number one, from a financial perspective, you're then having to pay current market rate for the new hire. But then also, will you even be able to find the person if you have the budget to pay that higher salary? So I think we can expect some of that cycle of, as we see turnover start to decrease, quits start to decrease, job openings decreasing, hiring overall falling, that delta between what current employees are making and what the market competitive rate is for today's salary, I think that will start to come down a little bit over time, and in a way sort of feed that cycle of fewer people turning over because they just don't have the incentive to do so. And then Jay, I think, what can companies do, or what should they be doing to avoid ending up where a lot of companies have been?
Yeah, I know. We've presented with Alex in the past where compensation is just one of the levers that companies use. It's not the only one, but it can be a very significant one. Where I would say I would be curious to know how many people over the last couple of years switched jobs because they got, quote, life-changing pay. Where it was, I absolutely have to take that opportunity. And so that's why, I mentioned a little bit earlier in this podcast that top end, I think, is going to really start to either go away or come down. That's going to put less pressure on some other folks, the companies that are hiring. And so, we're projecting more modest 2 to 3% next year in terms of overall wage growth. I think the challenge that companies have had over the last couple of years is, some of the points Mallory was making. When you go at this time of year and you're going to budget out for your employee costs for next year, and you're putting that normal 2 to 3 or 4%, depending on the company and how they do it. The misses they've had, to Mallory's point, was they might have budgeted 3%, but that person leaves and now they're paying 20% higher to catch back up with where the market was. And so there should be a little less of that, I think, next year as companies go, if you do have some turnover, which, as I mentioned earlier, we think turnover will come down. That side of the equation should be a bit more predictable. And then what will help with that is that you're not going to have quite as many recruiters coming in at these life-changing or very, very significant different rates. I think the other thing is you have to think about, what for your employees, where's their head going to be at as you think about, typically when there's uncertainty in the market, you're not ready quite. If you've got something that's been stable, you like your boss, your pay is helping you pay the bills or more, if all of that works and the market has a lot of just uncertainty in it, that's also going to be one of the things I think that helps companies as we look to next year. Long term, as long as inflation stays under control, look, it's for a long, long time. If you haven't, we do a very similar thing, but if you haven't checked out the Atlanta Fed's wage tracker, just Google Atlanta Fed wage tracker. It's a great tool. I've referenced it a lot over the years. Anybody switching jobs tends to make more money at the job they're going to. They typically don't try to take a pay cut. So that's going to continue, I think, but both of those numbers have been on a little bit of a runaway the last couple of years, more moderate next year, and we think going forward as well.
Yeah, so much great stuff in there. I personally find it very amusing how whenever employees come to their boss and say, hey, can I have a raise, please? Oh, sorry, the money is not there. And then they put in their 2 weeks and all of a sudden the money just appears out of the blue, right? It's fascinating. Of course, in many cases, by then it's too late. So you have to have that mindset of, what is it actually going to cost me to replace this person if they leave? But at the same time, you talk about the pace of wage increases moderating 2 to 3%. This will be the last question that I'll pose to you guys. Inflation is not likely to go back down to 2 to 3% next year, right? So that sets an environment where people are going to continue to feel like they're falling behind, right? The cost of living increases while their pay doesn't keep up. That's been a huge part of the conversation this year. What does that mean? Does that mean that the likelihood of some of the worst type outcomes for the labor market are maybe not as likely to happen? Or what are your thoughts on kind of how do we deal with that environment?
Well, I think it's just that's what we'll be studying to understand what's going to be the ultimate impact across different types of businesses. So I think, while some might be more protected than most, if consumers are spending less dollars or fewer dollars on certain goods because they don't have the money because things cost more, they're buying fewer things, and so ultimately it's going to slow things down, and prices at some point will either have to stall or start to readjust, or the consumers simply can't buy it in the first place. And so that's, I think, the plan and the thought of how this will all play out. But for consumers, they're going to have to figure out how, where can I cut back? Unfortunately, there are a lot of people that don't have a lot of room left to cut back. But housing costs, whether it's rent or mortgage, should start to moderate. That will help. Energy prices have also just seen a substantial increase. That should come down. We'll see about these fuel prices. I mean, they've come down in recent months, but they're still up a lot from the prior year. We point to one that we think's a little interesting. Oh. I have 3 teenagers, 2 of them boys. They eat a lot of food, and just going to we try not to feed them much fast food, but I went recently and the bill I could not believe. And so, you'll start to pick and choose and say, okay, I won't do that. I've got to find cook more meals at home, whatever I can do to save money. I think that's going to be a big, big theme for consumers next year.
Absolutely. Living beyond your means takes on a whole new definition in that type of environment, right? Mallory, anything you wanted to add before we wrap it up?
No, I think Jay really summed it up well. I think the other piece is, depending on how far the pendulum swings from employers to employees, and where the power is really figuring out, like we said, what are some other things that employers can do to, even to defray some of these costs. And then, as we've been looking at trends over time, consumption really has ticked up in more meaningfully than income. So, things hopefully, the pandemic unleashed really a whole set of chaotic, I guess, like energy in the labor market and economy overall. And maybe some of those trends will start to kind of come back down and just really normalize back to where we were. I think that's been one of the key words that Jay and I have been using. It's not really, hiring isn't falling, it's normalizing. Maybe it will start to fall, but really, how do we get things back to a more normal cadence, like you said, for the health of the overall economy?
Absolutely. I just wanted to say thank you to both of you. Jay, Mallory, you have put things into such clear context for us. I hope that the listeners understand this normalization trend that's happening and take away some of the advice that Jay and Mallory gave us today in terms of coping with some of the changes. But I think the key element is continue to pay attention, right? Things are evolving quite frequently and in many cases meaningfully. You have to look at the data particular to your business and then base all of your decisions on that. Jay, Mallory, thank you so much for being here today. We really appreciate it.
Thank you, Alex.
Thanks, Alex.
Absolutely. So I just wanted to finish things up here for us by sharing the upcoming episodes of the podcast. Bear with me one second. Here we go. So next week, we will have another episode of the Wholesale Change Show where Ed Gerber, the president and CEO of Summit Electric Supply, will join the conversation. And then another episode, another webinar on best practices in CRM now and in the future with Mike Marks. That's on October 27th. You can see below here all of the contact information for myself, Jay, and Mallory. Please do reach out to them with any outstanding questions you might have. And I highly recommend the Labor IQ tool for your compensation analysis. We talked about being a data-driven decision maker. That's going to get you exactly where you need to be regarding wages and compensation as you look out towards 2023. So with that, I say goodbye. Thank you so much for being here. I hope you have found some value in it, and we'll see you on the next episode of The Discerning Distributor. Take care.